Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, speaking to you on this very snowy day here in New York City. It is March 14th, 2017, and it marks the 8th year of this radio show. So I do want to thank each of you for listening and in making this show a success. I encourage you also to keep your questions and comments, criticisms and praises coming along to questionsfortaylor@gmail.com, questions, the number for Taylor@gmail.com, and I would like to invite you also to follow me on Twitter. J Taylor Media is my Twitter handle. So we'd also want to thank our sponsors for making this show economically viable. Without them, there would be no show. Dynacert, Inc., Golden Predator, Chilean Metals, Arvista Gold Corp, Novo Resources, Uranium Energy Corp, and Aran Resources are our sponsors for today's show. I've titled today's show, Doug Casey, Comparing the 1930s and Today. And Doug Casey, Dr. Quentin Henning, and Michael Oliver is with me and will be speaking to us just momentarily. Those are our guests today. You know, generals commonly fight a war only to find out that as times change, applying past strategies really don't work very well. In fact, can result in a disaster because times change and technologies change, etc. In the U.S., financial generals at the Fed and the Treasury focus policy on avoiding the deflationary depression of the 1930s. Well, make no mistake, we are heading into a depression, I'm sorry to say. But in fact, some guests on this show, like John Williams and others, believe that we've never really in any meaningful way recovered from the 2008-2009 Greater Recession. In any event, the Fed has fought that battle, the battle of the last battle, the 1930s battle, and even doing so more aggressively than it ever did in the 1930s. In fact, never acknowledged that the 1930s policies were a failure, only believed that they didn't do enough. So this time, by golly, they're going to do more than they ever did before to make sure that they have enough stimulus out there to make the thing work. But the big question we're going to talk to Doug about is, was the Fed right to worry about a deflationary depression? Or might we be faced with a hyperinflationary problem so that the so-called remedies of the Fed are actually worse than the disease? So that and other very important timely issues Doug will be opining on at about half past the hour. Dr. Quentin Henning will join me in just a few minutes after our first commercial break to give us an update on a company that is personally my largest allocation in my own account. And I'm talking about Novo Resources, one of our sponsors, which it's discovered a Witwatersrand type deposit in northwestern Australia that Dr. Henning is moving towards production. And I do consider this to be a very undervalued exploration story, so I hope that you'll stick around to hear what Dr. Henning has to say. But right now, we've got Michael Oliver with me after a couple of weeks' absence. It's really good to have you back. Thanks for being with me today, Michael.
Great to be back, Jay.
Always good to have you. You know, in your note to me this morning, you said there are parallels with the 1987 stock market, I guess prior to the infamous crash. Can you talk to us about that for a bit?
Sure. It's very common in a lot of market letters, and even in the Wall Street Journal, you'll occasionally see it, where a price chart overlay of a given market is compared to previous periods in history. And, it looks the same, therefore it's going to turn out the same. And usually that doesn't work. The overlap it disintegrates. However, what we did in a weekend report was to analyze the S&P now, not just on a price basis. That's the least important factor. But It looks very much like 87 on a daily price chart basis. But forgetting that, we dug down, we ran momentum studies of what happened in 87 on the S&P versus the momentum studies now. And quite often momentum, by the way, a lot of people will think that, well, if the price looked the same, therefore the momentum probably looked the same. That's not true, because there's a lot of subtleties in price behavior that could cause different-looking momentum trends to emerge. So just because a price chart might look similar to another one doesn't mean the momentum charts would. But lo and behold, they do look the same, very much like in 87. In fact, today's action is, when we close where we are last I saw at 2363, we're breaking something that we broke in 87. Now, this is not the crash. This was the first hard wobble off of the August high of 87. Because remember, the crash didn't occur till October.
Right.
Now, and again, I'm not forecasting a crash. What I'm looking for is a downturn that morphs into a larger downturn. And all I'm looking for right now in our reports is a sufficient sign from intermediate-type momentum trend violations that the S&P is, in fact, breaking down. Mm-hmm. And again, we don't expect that first break to be anything dramatic, not headlines, but just get us off the high and get the S&P such that next quarter, which is weeks away, we're trading in the 2200s, not the 2300s. Mm-hmm. Because if you're in the 2200s next month, next quarter, you're jeopardizing some big stuff, big momentum structures. If they break, you're really in real trouble. Now, the other thing we noticed was that the T-bond market, back in 1987, about 6 months prior to the S&P actually peaking, was in a hard downside move. In other words, rates were rising, prices of T-bonds were dropping. And opposite, the S&P said, I don't care about rates, I'm going up. And so up until August of 87, when the market peaked, T-bonds were really coming down, S&P was going up, total opposites. But then when the T-bonds, they hit a floor, and they hit a floor for, it might have been 2 months of horizontal action, where they didn't go down anymore. And the S&P, of course, partied during that time. But when that floor broke, and for us, that comparable floor broke a week ago, around the 148 level. That when that floor broke, that was when the S&P finally began to acknowledge that, my goodness, rates are going up, and it's serious. It's not something we can dismiss. And it was at that point, in late to mid-August of 87, that T-bonds started their second phase of decline, and the S&P started then to pay attention. And so sure enough, here we find ourselves about 40 points off the recent high, the S&P, and we're starting to pay attention. What then happened was the bonds just kept going down and down, and I called the bond market then, and I call it now the Judas goat, leading the cattle to slaughter. If T-bonds continue their decline, and we're major bearish on T-bonds, they've broken a lot of long-term momentum trend structures. We think rates are going up substantially, and it's not because of the Fed. We're talking long-term rates. What should unfold is that we get further T-bond decline in the next month or two, and the S&P really starts to pay heed to it. And at some point in early Q2, if the right numbers are hit, the S&P gets hit very hard. And we're, at that point, the public will recognize we've seen the high.
And then a massive exit out of stocks.
That's when the asset class shift really heats up, where money comes out of stocks and goes into less favored and cheap things like commodities.
Right. So let me understand, Michael. We got this Judas goat, and the Judas goat is a goat that's trained and used in general to lead animals, sheep and cattle, to slaughter. And the cattle, and they follow the Judas goat, and the Judas goat survives, but the rest go to their death. Are you suggesting then that because people sort of say, well, the economy must be doing pretty good, interest rates are rising, everybody sort of thinks everything's fine, is that it?
I think that's the fanciful argument right now, is that, again, forget the quarter point here and there by the Fed over a year or so. That's meaningless. Talking about real-world rates, 10-year notes, 30-year bonds, long-term rates in Europe, which are rising rapidly as well. Those are rates that are determined not by central banks anymore, but by the free market. The market has wrestled control of those markets away from the ECB, away from the Fed. They may play with the overnight rate at the Fed window, that's fine, but the 30-year bond is a beast on its own. And that's what we've been watching. And as far as I'm concerned, go ahead.
All right, Michael, we're just with 1 minute left here. I know that you're believing that the euro is ready to take off to the upside and the dollar is very weak. How are you looking at the dollar and gold at this moment with a minute left?
Well, I think that the 57% of the dollar index is the euro. Watch the euro, therefore. Don't worry about the yen, the Canadian dollar, all that. Don't worry about that. Look at the euro. It's 57% of the dollar index. The euro right now, the euro futures are trading in the 106.5 area. It's our view that if they close a day out at around 107, and we've been trading up there recently, but not closing a day there, that they're going to probably launch an up move. If that occurs, the dollar should shift back down through the low of the year, which was just above 99, a key level for us. The dollar index breaks the 99 level. As far as we're concerned, it's a major bear. That should further help the gold market.
All right, and you're not really concerned about the gold market at this point, I guess.
No, the gold's pulled back as far as we're concerned to an area of support. It's a zone, low 1200s to the high 1100s, to 1190 on up to 1220. Let's call it a zone. And in that area, I expect to see some congestion phase, some basing out action, and probably a decent little rally the next day or two. I'm not looking for a fireball upside. I'm just looking for it to stabilize. It had a 5% pullback after a 12% rally. from the December low.
That's fair enough, fair enough. Well, we're out of time, unfortunately, Michael. Thank you so much for being with us again.
Thank you.